What's up, everybody? Michael Silva here. You're watching the Stock Market Brief Show. In today's episode, we are going to be talking about how to prepare for the next economic earthquake, earth-shattering. We got some important data to go over. As always, we use technical analysis, intermarket analysis. If you're new here, make sure to hit that thumbs up and subscribe to the channel if you like technical analysis and intermarket analysis. We're also going to be discussing other things taking place in the market. I'm going to give you some of the trade ideas from my Discord. I'll give you a couple of those just so you can have a kind of a insider's look there. And then we're also going to get very tactical on the short term because there is still opportunity, obviously, from the long side, as there may be opportunity in the future to the downside. So let's get into the show. All right, everybody, welcome back. The Vision Pro, as we all know, came out, and as soon as it dropped the price at $34.99, I love how it's just not $3,500, you know? There's something psychological here. The crowd went crazy. No, actually, if you had video of it, it was pretty funny because they're like, oh. And then all of a sudden, the stock price from Apple really took off. But hey, augmented reality, I recently learned this from this book that I'm reading, but carbon fiber augmented reality helmets that are used in the Air Force, those things are not $34.99. Those things are $400,000. By the way, great book and some great stories in there. And it's actually really applies to traders who have to make quick decisions. So good stuff. What took place in the markets today? Everything was basically there in the red other than the NASDAQ 100. Tech is still managing to hold up. The ones that got kicked in the thumbs up was the small caps down there at 2%. If we take a look at Bitcoin, Bitcoin's pulling back a little bit. Some news came out. The last time I talked about Bitcoin was this rising wedge structure. We said if it breaks, maybe it comes around 25,000. Well, we're trading around there, so we'll see if it continues. I personally haven't been trading it. I've been waiting for the buy signal on the Sailor to Shift tool that I like to use. If you don't know what this is, it's a buy and sell signal that I put together. I made a video about it, and I show how I personally use it. But it's been on a sell signal. We had a buy signal, but there was no trigger, so I couldn't go long. At least according to my plan. So the last real signal and trigger was the sell signal, and price is kind of falling off. So if this can come back up and we get a buy signal, I'll be looking at crypto equities, maybe BITO or something like that. But like I was looking at Mara, and I was very interested in going long this, but the only reason I didn't is simply because I just didn't get confirmation yet on my buy signal. And this is still might turn back around, but prices get contracting here really tightly. And as we know, markets move between expansion and contraction. So if this starts breaking down, watch out, because that could get pretty violent as the volatility that increases from the expansion may be potentially to the downside. Same thing with Riot. Riot was looking really good here too as well, but we just had a couple of days, including today, down pretty big today. Today was down 8.8%. So if this starts, coming down, but then we start getting a buy signal here and Bitcoin starts recovering, these could be some names that actually you can benefit from swing trading from the long side. Now, we talked about the earthquake, and I want to reiterate this specific chart and why do I think that there's an economic potential earthquake coming, a recession coming, and what that actually means and how we can actually prepare for that event if it were to occur. Right? We don't need to necessarily worry about, what the situation may bring outside of our own lives, but we need to prepare our own personal economy to withstand what could potentially take place. So I'm looking at this cycle chart, and the cycle in orange shows the stock market. The blue is the business cycle. Clearly, you can see the stock market leads, and then the business cycle lags. And this is what actually really tipped us off going into 2022 for the bear market, when we started seeing consumer staples, utilities, and healthcare, even energy performing the best up here. And we kept on saying, oh, we might be making the turn. Then it's going to look still like the economy is getting good as time progresses. Well, now take a look here. Technology, communication services, and discretionary. And if you just go straight down the line, right, if you just look straight down, where does that put us in the business cycle? That puts us right here into full recession and around the market bottom. Well, how are we doing year to date so far? Technology, communication services, and consumer discretionary are all the leaders. So as it stands right now, from a price action perspective, okay, I'm not even talking about macro yet, price action perspective, it seems as if we are moving into the realm and time frame of going into a recession and trying to carve out our market bottom. Okay, and be mindful that recessions, they can bring obviously more volatility to the markets. Now, from a macro perspective, we still have a very inverted yield curve, and this is the best predictor of a future recession. And now that we're still inverted, what I wanted to just point out as we're, talking about the Fed potentially pausing here and then reducing rates, right? They say higher for longer, and that may be the case because they're kind of stuck in a very, difficult situation to say the least. But as we uninvert and then the Fed starts lowering rates, we've seen obviously some volatility into the market. Even right here, boom, a quick inversion, rates down, we moved up, we obviously moved down from the pandemic crash. And now we're very deeply inverted, but we still haven't really came out to uninversion, and that could be a very interesting time, obviously. And this is more of the macro look. But if you just take a look here are some macro data reports that you can pull up yourself, and you can look that they're all slowing down, and it's not a good sign overall. One of the ones that I really like seeing here is loans and leases. So this is really credit growth. Are we tightening or are we not from a year-over-year perspective? And this is dating back to 1975. And what you'll notice is these gray shaded areas, those are marking out recessions. And we don't have a gray shaded area right now because we're not technically, I guess, labeled or told that we're in a recession. But what you'll notice is every time that we do have a recession, prior to that and going into it, we had a slowdown in credit growth. So we've had slowdowns in credit growth before that don't lead to recessions, but every recession here on the screen, you can see a slowdown in credit growth. And the reason why I'm calling that out now is because we clearly are slowing down there as well. And remember, the Fed is trying to fight inflation. So if we look at core inflation, we're still high, but you don't need this report to tell you that, right? A lot of people are saying inflation's coming down. I'm sorry, I go to the gas station and at mine, it's almost still $5 a gallon. There are some places that are still $5 a gallon, which is crazy. When we go to the grocery store, I'm paying so much more money for my groceries. So the things that matter to the everyday person, it is really constricting overall, and I'll show you proof that it's not only me that can see this. I know that other people feel this, and you can see it in credit card delinquencies and such. We got United States ISM Services PMI coming out today. It's basically almost there into contraction phase. It's still above 50. I'm not going to dive too much into that. We also have a 30-year mortgage that's ticking up, okay, near 7%. It's 6.79, so that's pretty wild there too. And I know that a lot of people think when I'm saying this, oh, that means, so is the stock market going to crash? I want to reiterate this. By the way, right, this is something I post on Twitter. This does not mean a crash is incoming. The price may indeed fall, possibly reaching to a new low. I mean, many times we don't find a low until after the recession is told, right? Or perhaps not. What it signifies is that you should get your economic house in order. Okay, so don't be the one who has an increasing credit card balance, higher interest rates, depleting savings, and piling up delinquencies. Pay off your consumer debt, establish an emergency fund, create an opportunity fund, and maintain a steady stream of income. Now, this is pretty crazy to me. So if I look at 90-day delinquencies, look at the credit cards. It's 90 days. This is serious delinquencies. This isn't 30 days late. This is 90 days. So this is what I'm like. My thought process here is like, okay, well, inflation is still here. Gas is still incredibly expensive, at least here in California. All right. Groceries are still expensive. And people are still trying to live a lifestyle that, with this current inflation. And you're seeing now credit card delinquencies going up, meaning that they're racking up credit cards. We've already discussed in prior episodes a while ago about the slowdown in deposits. And the slowdown in deposits amidst also the yield curve inversion was a recipe for disaster for the banks. And we were talking about that before the banks. We've always said that that's horrible. Okay, but then look at the auto loans. Auto loans, right? Vehicles are still expensive too. We're starting to see 90-day delinquencies here start to pile up as well. Now, on top of that, what do you see here with student loans? Well, delinquencies here fell off a cliff. Why? Well, because of policies. Okay, but we're coming into, the summer, and the end of the summer, apparently students are going to have to start paying back those loans. So think about it. Prices are high. Things are still expensive. People are racking up credit cards. Their auto loan delinquencies are picking up. Credit card delinquencies are up. And then all of a sudden, what? They're supposed to pay their student loans on top of all of this? And you can break this down per age too. I'm not going to do that on this episode, but here's the reality. The bill, the debt ceiling that passed, right? So the bill does end payment pause. What the debt ceiling deal means for student loan borrowers. Okay, so basically, if you go through this article, it's telling us, I think it was August 30th is the cutoff where it starts to resume. So we'll see, because anything could potentially happen from here to there. We don't know if necessarily that's going to be the case, but I wanted to call that out, and all of this because of the fact that, yeah, don't be caught off guard. And it's all going to look obvious in hindsight. Does this mean the market's going to go boom and crash? Not necessarily. It doesn't mean that. There's a lot of opportunities in the market, which I'll show you right now, right? A lot of people say that I'm overly bearish, but if you're actually in the swing trading Patreon group, if you do Patreon, it's $9 a month, or sign up annually, it's $90. I give a lot of trade ideas. I show my watch list. I give monthly, daily, weekly expected moves. I give zones, which is, I'm not going to get into that right now, but that's a pretty cool indicator, and I extract a bunch of data from that just to get a good overall view of the markets. I even share my charts, the stock market indicators that I share here on the show. And then you get access to the community. Okay, so the trade ideas, the majority of them that I post are all long. So I'll just give you a couple that, I recently just posted. This is IDCC. So this is like the semiconductor name, right? So semiconductors, they ran a little bit, so maybe this gets stopped out. But the type of trades that I share are the ones that are in a period of contraction. So you get a explosive move. It's already high. It's in bullish context for the most part. And now it's consolidating, right? And the reason why I like these type of trades is because we already know that contraction leads to expansion, right? And then when you get really tight again, contraction leads to expansion. Contraction, it either leads to expansion or expansion. And you want volatility to be on your side, but you go, okay, this is in bullish context. It's flagging. Okay, so if it starts getting down here, chances are be careful, get out of the trade. But then you also have, potential area. This is just a measured move of the flag, is all that is. So it's an idea for a target. I don't personally like giving targets, but here's one, IDCC. It's currently flagging. It's consolidating. So if it breaks out, hey, maybe we start cracking through this high over here and we start running for that $90 region if semiconductors want to continue to run. Here's CPRT. I believe this one is a transport, if I remember correctly. But this one's also a very similar situation. We had an explosive move right there, and now price is kind of flagging, consolidating. If it gets below a certain area, it's like, okay, may need more time to set up or digest. But if I like playing breakouts, right, or potentially entering in a little bit, and then I'll add on a breakout. But it's currently flagging or triangle or whatever you want to call it, and a measured move would bring us up to around this area. So those are just a couple of the trade ideas. You can kind of follow along and put these on your watch list too if these are the type of setups that you like. Let's really kind of dive in though now to the 15-minute charts, and I'm going to go over quite a few of them. I'm going to go through the big index products. I want to first start off though. Before I do, I just want to show the BP chart for technology sector. So as it stands now, and if you don't know what this is, it's the percent of stocks based on buy signals, the percent of stocks on buy signals based off of these point and figure charts. And the point and figure charts are the tic-tac-toe charts, okay? They have the X's and O's. Well, we're already right around 80%. And 80% is a pretty frothy area, as we've seen before. When it gets up here, it kind of comes back down, okay? But I want to call out that not only are we at 80%, but we have a negative divergence that's forming. And this is, like I said, technology stocks. And we already know that technology stocks, boom, they made a huge run. So chances are this could be the area where we start to digest, start to consolidate. Doesn't mean crash. It could mean flag and create more opportunities. Actually, one of the opportunities, trade ideas that I like to look for is something called the Holy Grail. The Holy Grail is a trade strategy. I made a YouTube short on it. You can Google it or you can YouTube it. And I quickly show what the parameters are to trade that specific strategy. That was in a book called Street Smarts from, I believe, the early 90s. Okay, so yes, negative divergence is forming. The last times we had these was right here. They're the red lines, so I'll draw them in blue. Okay, boom. What did price do? It went down, but then it went up, but then went down, but then went up, but then went down. Okay, but then in that time, we also got to a oversold condition there too as well. Over here, it marked the April bear market top, that negative divergence. Over here marked the August just about bear market rally top. And then over here in December, it also marked this little top before coming into 2023 where we were what? where we were oversold. So this is one of the things. If you go back to when we started getting oversold, you'll hear videos of me saying, this is where, we're oversold. And you'll have a lot of people, right, in the comments going, no, we're crashing, we're going to break the lows, this and that. Yeah, okay, well, this is not necessarily where you want to short, okay? That's just from, you can just go back and look. Like, I'm not just saying that just to say it. Every time that we get back down there, you can get lucky, but there's sometimes positive divergences for them, and that marks, sometimes short-term bottoms. The next thing is the back month versus front month volatility. Volatility on the VIX is obviously getting crushed. The front month, boom, it's way ahead of it. It's about 21% higher than the VIX, and this has marked out times where we consolidate or where we pull back. And you could see that here, here, and here, where it marked these ends of these runs. And when we recently got here, we've been trading up in this area, and prices kind of just went sideways. Then it started backing off. We took off, and now we're back up in this level again. Okay, so let's dive into the 15-minute time frame. I didn't have a weekend recap. We did finish within the weekly expected moves. Here are the weekly expected moves now. 422, 31, 433, 53. Those are the weekly ones. Those are the orange. The daily is the white lines. So the last time we talked about this channel, wait for a breakout, and we might be able to push higher. We did. Okay, cool. Now what? Okay, now I'm watching the month-to-date anchored VWAP. Why? Well, you can see price got above it. We tried to come down. We didn't even tag it yet. We moved higher, and we haven't even tagged it yet. Now, coming into tomorrow, what I want to do is I want to see if price can reach down here, maybe potentially lower, and either do a U-turn where basically price comes out and then you buy back up through that. There's a bunch of different names for this type of trade, but it's basically, you might get an undercut and then price builds a base and then starts getting more strength. I just consider it a U-turn in price, just like, boom, U-turn there too, all right? It's both bearish and bullish. Okay, but the average volume weighted price, let me fix that, is right here at the lower daily expected move. So you might have this little flagging here. If we get some more weakness, start to see how price acts into this area. If it starts basing out and you buy back through on strength, that could give us, potentially this just being a pullback. And then we go and we try to retag this top and potentially even go even higher. So this is an opportunity from the long side. Yes, things are a little extended. I get that. But overextended could stay overextended for a while, as we already know. Okay, that would be the more bullish trade. Obviously, if you're more bearish, I like to be under this purple line, which is the 5-day moving average. So we're pretty far off of that. So if we come down here, I still wouldn't actually short into the lower weekly expected move, right? Because 68% of the time, if you're thinking of this as a bell curve, we close within the weekly expected move. Just like we did last week. We got outside of it. Statistical trade analysis would tell us that we're going to come back in. And, well, we did. Okay, and the same thing goes here with this, expected move, whatever that drawing was. Okay, so that's kind of how I'm seeing it. If we pull back into these areas, I'm still looking for potential buying opportunities until we start really seeing a series of lower highs and lower lows, and we get below the 5-day moving average, and it starts turning back over. Now, the Qs. So the Qs have also been very, very strong. This is more tech related, obviously, and we talked about here how we're kind of overextended. So I'd be a little bit more hesitant here, as I think that we need to digest. But in the short term, we are still bullish. Now, if we come down to the daily expected move for the Qs, that's 351.97. That's in line with an inclining 5-day moving average. So if we, this is a little bear flag. If we do break down, what I would say is, okay, be patient, okay? See how price works in this area, and then we have a month-to-date anchored VWAP here. If the month-to-date gets retested and rejects, and then the 5-day starts curling over, then I'd be a little bit more bearish, okay? So be careful there. However, if price does come down into this area, and then we start bouncing up, and we U-turn through, boom, the month-to-date, and we recapture that, that could mean that this is just being a quick consolidation before potential push higher, okay? Now, we're below the week-to-date, so also, you got to be aware that the week-to-date is also prices below that. So if we get above this, that opens the door to hit, obviously, the upper daily expected move there too as well. Now, the IWM, the reason why I'm talking about the month-to-date anchored VWAP right now is because if you look today, actually, the IWM, right? I was actually intraday looking to play a U-turn here on the, if I anchored a VWAP on this big day, boom, and then price started pulling back into it, but then it got underneath the VWAP, did not do a U-turn, did not set up for a good trade. But that's fine. That's why we manage risk. So month to date, you can see price pulled into that area, okay, and it bounced from that level. So IWM did come into it, which is why I'm saying, okay, let's see if SPY gets down there, okay? Let's see if Qs get down there and how it responds down there, okay? Now, as it stands, IWM is below the week to date. It's above the month to date, so it's kind of between the two. So, and we're not too far off from the lower weekly expected move, and we're above the 5-day moving average. So as price goes sideways or, around here and stays above, this will start moving up, and it'll come into potentially around the lower weekly expected move. So we have a high, we have a lower high, we have a low, we have a higher low, and then we have obviously this low here. So just be aware that if we start breaking down through this, that opens the door obviously to this lower weekly expected move. But once again, these aren't necessarily the areas that I would be looking to short into. We had a very strong move, and all we're doing is really consolidating that move as it stands. So I'm still rather bullish here until price tells me, confirms to be more bearish, at least in the short term here. Okay, and then the DIA, so the Dow Jones Industrials, right? Big strong move. Price got below the week to date today, and we're flagging, right? We could be very well flagging. We had, lower highs, we have lower lows here. Now, if price pulls down into the month to date anchored VWAP, that's kind of lines up with this lower channel. So if, price comes down, but see how price responds in this area. If we start getting back up to strength, you can buy back through, and it potentially is just a bull flag that can still obviously take us higher. Now, if it starts breaking down from this, now be patient, because price, you'd want to see price recoup it, because if it doesn't and it holds as resistance, that opens the door down to here. Not necessarily meaning to short it, because we're still above that 5-day moving average. So that's a couple of ways that I'm looking at this. If we don't get down there, maybe you'd want to see price recover this little lower high here, or this potential lower high, and reclaim the week to date anchored VWAP. If it reclaims that and it can hold and build on the higher lows, that opens the door to play trades, obviously more to the long side as well. That was a lot on today's episode. We talked about the potential earthquake, how to prepare yourself, just your own economic house, things that I personally will, stuff that I do. And then we obviously got very tactical from a short-term perspective. Hope you all had a good weekend and have a good week. I'll see you back here tomorrow.